Well, I'm one of the directors here, and yeah, really glad that everyone can join us. It's something that I'm really passionate about, is understanding financial information, because the average understanding, unfortunately, across a lot of clients and a lot of people, is not so flash. So for those who don't know us, Singapore is the Bay's largest locally owned accounting practice. We've got a team of 45, and we help our clients throughout the Bay and the wider New Zealand, really. We have people across everywhere. We have expertise in our 6 partners across lots of industries, but we particularly focus on construction and trades and horticulture. It just seems to have worked out that way, not through any grand plan. Our clients often come to us because they want the depth of experience and the breadth of service that we provide, and also the comfort, especially these days, that the wheels don't fall off if just one person's away, given that we've got a big team, but they still appreciate the personal relationships with partners and our client managers. One of my specialities is helping people buy businesses. So a lot of people buy a business, but they haven't done it before. They're not professional business buyers. It's the one time they're ever going to do it. And so it's a big challenge and a privilege for me to help work with them to increase their financial understanding. And one of the reasons I'm passionate about this is, and I'll just tell a quick story, is I took over from a retiring partner 5 years ago. And when I met his clients, many of them told me, look, I really trusted that guy. He was a great guy. We went back a long way. We were together 20 years. But I never understood a thing he said. And they said it with a smile, like it was a little joke. And I would cringe inside just a little bit, because really for me, if people say that about me after working with me for 20 years, I think I'll be a bit disappointed. I really want my clients to grow their understanding. And that doesn't mean knowing everything overnight. And it certainly doesn't mean knowing all the same things I do, because they don't want to. But offerings like this webinar will hopefully help. So before I really get into it, I thought I'd share a thought for this session. The budget is not just a collection of numbers, but an expression of our values and aspirations. Hopefully you've all updated your budgets and forecasts, and you're starting to think about that for the next year, and reflecting on the challenges of COVID-19 and logistical challenges and all the other challenges that are going on at the moment. So those numbers express your aspirations for the business over the next 12 months, or maybe 24. Now it's the time to make sure you can understand, monitor, and measure what you've set in those budgets. There's no point just putting numbers to a page if you're not really that clear of what it's telling you. So they should be driving decisions, driving action, not just telling you that something is up and something is down. So this webinar is about demystifying the most common reports you'll be seeing on a weekly, monthly, quarterly, and maybe annual basis, so that you're in control of your business performance. I really passionately believe that once people do feel confident about their numbers and their business performance, they're able to have better conversations with me, better conversations with their banker, and really just feel a whole lot more confident about the state of the business. So today we're going to cover, and hopefully, well, in under 60 minutes, I think we'll come in comfortably under time, the importance of knowing your numbers, have an overview of the different reports that you should be producing, or someone should be producing for you, the difference between profit and cash, the key drivers of business value, how to protect your assets, we'll just touch on that, and how to adopt best practice that some of our best clients do. We'll then outline some potential next steps for you to take to make sure you truly understand your numbers. Please make sure you take plenty of notes. Some of what I talk about might sound like a foreign language. That's all right. If you could learn it all straight away, I'd be impressed, and if you, and surprised, frankly, because everyone's at a different point in the journey, and it's about picking up the next step. It's not picking up all the steps in one go. It's usually not really going to work. It's a journey. So if you do, sing out with a question for Larissa, because if you don't follow something, what I call accountantese, bet your boots someone else won't either. So why you need to know your numbers. So knowing your numbers is vital, as it allows you to interpret your reports and know if you're on track to achieve the goals set in your business plan or business recovery plan. So my top 6 reasons why you need to know and understand what the numbers are telling you is that the first one is they tell the story of your business, allowing you to interpret the results of your business activity. So it's a lot more than this number is up and this number is down. It enables you to understand, okay, this number is up compared to this one, but why is that? What's changed to cause that? This helps you identify the symptoms versus the root causes. For example, a decline in gross profit is a symptom of many root causes, such as ineffective pricing. Maybe there's rework going on. Maybe there's some bad purchasing. Maybe there's wastage. There's a whole bunch of reasons. But until you understand the numbers, you might not know to start looking. So knowing your numbers will enable you to spot an early warning sign of a potential issue. For example, monitoring how long it takes customers to pay you allows you to quickly respond if that number starts to increase. And in this time of uncertainty right now, and I guess it's been uncertain the last few years, but keeping track of your debtor days as an example is a big one. Areas of strength and weakness, number 4, will be highlighted. For example, your balance sheet indicates whether your business value is going up or down. And yet, I guess I would estimate a lot of my clients, they might understand the basics of understanding your balance sheet, but they don't understand the next level, which is how to make it work for you, let alone how to explain it to someone else. Understanding your numbers also means you've got a reliable financial information to base your decisions on. So it's more than just the number is up, the number is down, but it's saying the number is this. That means I'm going to do X, which will cause the number to do this. And then you can, that's how you should be driving your budget. And then you can go back in 6 months' time and say, well, I did that. Did it have the cause, did it have the effect that I wanted it to have? And finally, knowledge is power. The more you know about your business, the better you'll be. And I'd suggest the more confident you'll be. And for a number of my clients, the better they'll sleep at night, frankly, because I do see them and they come in and where there's a lack of understanding, there's nervous, sometimes there's embarrassment, and there's no need to be when they're talking with us, but I think a lot of people don't feel confident. So that's part of our job, is to give them more of that. So overview of the key reports. So these ones listed on the screen, we'll be reviewing each of these key reports to help you understand what you can learn. We'll go through an example to show some key learnings and things to look out for in the reports. We'll use the same fictitious company foods code for all the examples. So starting with the trading account. So it might not be called this in your annual accounts. It might be something that just sits at the top of a profit and loss statement. But this tracks your sales, your variable costs, and your gross profit to calculate the return you're achieving before deducting your fixed overhead costs. Your gross profit percentage indicates whether your margins are improving or deteriorating. You can track your results across different divisions or product lines using multiple trading accounts. And software like Xero is really great for that now. So if you've got, say, regional locations, ideally you want to have a trading account for each of them so that you can know that your Bay Area is doing one thing and then maybe Hamilton and Waikato is doing something else. Now that might be locations, it might be product types, it might be staff members or teams within a business. The small adjustments to the items in your trading account have a huge impact on your overall results. And I'll work through a quick example now so that that's really clarified. So this is an example of food manufacturing company's trading account. As you can see, they had sales of just over $1 million. If you see the yellow rectangle that popped up there. Cost of sales of $318,000, which meant they had a gross surplus from trading of just under $700,000. Their direct costs were over $450,000, and their gross surplus was $248,000, giving a gross profit percentage of 24%. So that means for every dollar of sales, they're banking 24 cents. So let's say this company undertakes some coaching with their accountant or their business advisor and implements some strategies to increase the customer retention rate, resulting in a 10% increase in sales. And maybe they work with someone and their accountant to review their inventory processes and reduce their cost of sales by 5%. So then they renegotiate their contract with their delivery provider, and that gives them another 5% savings in direct costs. So as a result of these changes, this is where if you're in the room, I'd ask for hands, but I'll let you off because you can hide behind your screens. And that makes a huge difference. So their gross surplus has increased by $140,000, and their gross profit percentage has increased from 24% to 35%. So it's a massive difference. But basically, they've gone another half again on their gross profit, and their business is making a whole lot more money when they're actually not that much more busy with their sales. Understanding your trading account allows you to identify areas where small improvements can have a big impact on profitability. So then the next piece down, and it's often, well, it's totally connected to the trading statement, is your profit and loss. Sometimes it's an income statement. It shows your earnings and costs over the year, tracks the overall performance of your business. It matches your income and expenses for a period with adjustments made for timing differences. For example, sales that have been made in the year, but you haven't been paid yet. So that might be sitting in accounts receivable. It's important to remember that profit is not the same as cash. The profit is shown in your profit and loss statement. It includes non-cash expenses such as depreciation. You've got to ensure you've got sufficient profit to cover cash costs such as paying loans, loan principal, asset purchases, and drawings. There's a lot of times where I have conversations with clients and we'll talk about the quarter and the great result that they've had. And then they'll look sideways at me and say, well it doesn't feel like it because there's no money. Your profit and loss statement provides a framework to benchmark your results by using percentages or comparisons between years to compare your business performance to similar businesses. And that's if you can get information against other businesses to understand how you're doing, that's ideal. Unfortunately, there's a bit of a gap in the market. There's not good industry information of what different industries should be performing at. But it can be a good conversation potentially with your bankers because they might have access to that. And sometimes we do as well. Businesses are generally valued using a multiplier of earnings. So your profit and loss statement's a real driver of the value of your business. The higher your earnings, the higher your value. So if we look at the profit and loss for the same company, we've taken the gross surplus from the trading account and listed all the expenses, followed by owner's remuneration, owner's pay, to calculate the net surplus or loss. So as you can see, currently the company is not doing so flash, $113,000 loss after everyone's been paid. And let's say the company undertakes a review of all their expenses with their accountant and identifies potential savings to be made to their insurances and rent. They contact the insurance broker and their landlord and negotiate a 5% reduction for both. So just from doing that, they've saved $597 in their insurance and just under $3K in rent. Now, and I'll just highlight, it does mean their accounting fees have gone up. But remember the previous example, the company engaged your accountant for coaching and services. So, and sometimes you will have to spend money to save money. There is a trade-off there. It might be an accountant, it might be a business coach, it might be someone else again. But it's not just about shaving things, it's making good investments. So despite increasing those costs, the overall net surplus has increased by 138 grand from a $113,000 loss to a $24,000 profit from these savings. So I'd say a pretty material turnaround in the business. So that's the profit and loss. And the next one is the balance sheet. So typically people have a pretty good handle on their profit and loss. And as I work my way down the reports, the grip on the handle starts to loosen. So most people will understand the ins and outs of the balance sheet to a reasonable degree. So sometimes it'll be called the statement of financial position. And it just means at a point in time, what is your financial health? Where are you at? What assets do you have? What liabilities? So it tells you the net worth of the business to a point. It shows if your business is solvent. And this is if your liabilities are greater than your assets and the business is insolvent and urgent action is needed to fix this. One of the real dangers, and I think unfortunately we're going to see that happening a little bit more in the coming months, is businesses trading insolvent. And one of the big risks, which I'll just diverge onto for a minute, when you do that, is if you're trading insolvently, is that suddenly that asset protection of trading out of a company goes away, and then directors can be held personally liable because a business isn't meant to trade while it's insolvent. You can compare different periods on a balance sheet to determine whether the business's net worth is increasing or decreasing, and that will help track the strength of the business. And the stronger your balance sheet, the easier it will be for your business to survive a downturn. And it also provides a basis for calculating key ratios, such as what your debtor days are, how long it takes people to pay you, and is that going up or down, and the number of days of inventory that you might have. are classic ones. So as you can see, the company is currently insolvent as it has more liabilities than assets. Its working capital is negative as it has current assets of 138,000, but those are less than the current liabilities of 162. So the current assets are the short-term things. Current liability is short-term within a year. So the company can't pay its short-term debts from the limited cash, the debtors and stock it has. Urgent action is required to fix it. For us, we're going to be in real trouble. The business needs money, and that's really going to come from two places. There's only two places that fund a business, and it's either a bank or it's you as a shareholder. So assuming the company can resolve these urgent solvency issues, there are other areas for improvement too. So over the long term, the company could implement strategies to reduce their debtor days and inventory days to increase their cash flow. Knowledge is the first step. Once you know what it is, then you can figure out some strategies to make amends. So to calculate your debtor days, you can divide the debtors balance, so accounts receivable balance, by your sales or your turnover, and then you times it by 365. This tells you how long it takes customers to pay you, and in this case, it's 26 days. So that once they send a bill out, they get paid 26 days later. So if they were to update their terms of trade and requested payment, say within 7 days, and managed to reduce it from 26 to 21 days, so pull it back by 5 days, this calculates there'd be an additional 14 grand in the business. And that can't always happen overnight, but it can be achieved. So inventory days is another classic one. So to calculate that, you divide your stock, your inventory, by your cost of sales times 365. So that tells you how long the business holds its stock before it sells it. In other words, it shows you how long your cash is tied up sitting on the shelf as inventory before it turns into money in your bank. If we were able to make improvements to your processes and reduce the amount of stock, they might be able to improve their days of inventory by 9 days, which will give them another 8 grand in the bank. So, yep, this total doesn't fix the solvency issue entirely, but $22,000 is pretty meaningful to a lot of businesses. And it's just about having the good financial understanding at your fingertips to be able to say, well, what tangible things can I make? Not how do I halve my debtor days, or how do I make it so that people pay me overnight? Yeah, that would be great. It's not always achievable, but small incremental changes often are with effort. So the statement of changes in equity. So most of my clients I've totally lost at this point. What this means is it's telling us what's happened to the profits. So the profits could be paid out as dividends or kept in the business as retained earnings. It represents the net worth or the value of the company, and it's a key indicator of the company's financial health. It shows whether a company's insolvent. Remember, if the company's got more liabilities than assets, it's insolvent, and funds will need to come into the company if it wants to keep trading. So that's quite a simple example. The company's got accumulated losses for the last 3 years. It means the company has no retained earnings and is currently insolvent. There's no money to pay out as dividends because equity is negative. No money to reinvest in the company to buy new assets. Directors really need to take action now to increase the profitability so this equity can get a lot more healthy. Now, if I lost you at equity, then almost certainly clients get lost at the shareholder current account stage. But it's really not so difficult. The current account just records all the personal transactions between directors and shareholders and the business. So it records all the money that's been put into the business by shareholders and then taken out. It can help you monitor your personal expenditure from the business. And for businesses with more than one shareholder, particularly, it maintains a balance of the amount each shareholder has put in or taken out of the business. It shows the business how much it owes to each shareholder. So if the account's overdrawn, it means the shareholder's actually taken out more money than they've put in, and it now owes the company money. And that's something your accountant does get a bit jumpy about. And we have always got suggestions of how to fix that. So to put the account back into positive balance, the shareholder could repay some of that debt, could put money in. That does happen, but and particularly in situations with multiple shareholders. But more commonly, the company could increase it's shareholder salary that it pays, which just means it credits the current account and creates an entitlement for the shareholder to take that money in the first place, balancing it off. Or another way is that a company might declare a dividend. If your shareholder account is sitting as overdrawn, it's expensive. The company has to charge you interest because basically it's giving you a free loan otherwise, and then you run into fringe benefit tax issues and a whole lot of problems. So that's something your accountants will be looking at. So if it's overdrawn, it's important to talk to your accountant and just find ways to make sure it doesn't get overdrawn. Typically, I find for a lot of clients, that means trying to treat your business less as a personal bank account. So firstly, paying a good level of wages if you're working in the business. And then secondly, potentially setting up dividends to match the amounts that you are drawing from the business. So that at that point, you're only ever drawing out money that you're entitled to in the first place. So in this case, the shareholder's current account shows that at the start of the period, the company owed its shareholder, Mr. Doe, over $29,000. So you can see at the top of 2020, probably need to update these years. Moving on, he's put $2,000 into the company during the year. So that might be, let's say there was a home office claim and he's paid $2,000 of costs for his home office on behalf of the company. So he gets a credit in his current account for that money. But he's taken out over $9,000 in drawings and life insurance. So it means at the end of the period, the company now owes him under $22,000. That's fine. That's the way it should be. It should be that the company owes him. We don't have to do anything. But it just means if there is $22,000, maybe a vehicle that's not needed gets sold, he could draw that money out to the tune of $22,000 and he wouldn't be overdrawn. He's entitled to it. We do have to watch, though, that the drawings that are taken out is only happening if the company is solvent. So if the company was insolvent and the shareholder took money, that can be problematic because then is he paying himself ahead of paying creditors? And to ensure the company will be able to pay funds that are put in by shareholders, that could be something where you're working through how to improve the profit so the company makes more money so that then more can come out. For example, in the example we had before, there wasn't big changes, but it made a big change of $138,000 of extra profit to that business. That money can come out to shareholders. It's not sustainable, obviously, to just keep tipping money in. Nobody wants that. We need to get things profitable. So the fixed asset register, this one's more straightforward, sometimes called depreciation schedule. Records a business's fixed assets like vehicles, plant, equipment, and it just means it's helping facilitate the spread of the cost of assets over their useful life. IRD tells us how quickly we can depreciate things. It provides a basis for keeping track of a business's assets, and it can be a useful guide to determine when assets need to be replaced so they can be budgeted for accordingly. It's useful when selling a business, particularly a buyer will want to see this as it records the book value of all the assets. And the more the buyer can put on the value of the assets, the better for their depreciation. So there's sometimes some value in people or confusion where people will record an asset, but it will go through as, say, a low-cost asset on the profit and loss. It could still be recorded on the fixed asset register, but just maybe depreciated straight away. It's quite useful if you have material assets to have a single place where they're all at least recorded that you own it. Otherwise, you end up with sort of the accountant's records of assets, and then your own role really is just in your head. So if you're not sure, again, ask questions of your accountants to make the best use so that you don't lose track of assets. So just briefly, the first column of the fixed asset register is almost always going to be it'll be the names, and then you've got the opening value and the cost. So it's just the cost is what it says, the cost, there's GST in most cases. And then the next column is the opening value, shows the asset at the start of the financial year. So that means it's the cost less any depreciation that's been claimed in the past. Then it's just showing anything we bought and sold. It's telling us then in these next columns, what's the depreciation rate that the IRD allows and what's the method. There's two methods. One is diminishing value and the other is straight line. The straight line just means if it's 20%, it means it's going to be down to zero after 5 years. And diminishing value just means we're reducing the opening value by that percentage each year. And so it becomes more of a curve, quicker at the start and slower at the end. That's the depreciation that's going to hit our profit and loss for the month, for the year. What have we totally closing accumulated depreciation is what's our closing depreciation over however many years we've owned it. And then the value, that value, the bottom right number will be sitting on the balance sheet as fixed assets. So these were the 6 key reports, and we blasted through those pretty quickly. But if you've got any questions, fire them through and we'll try and get to them. In the meantime, let's move on to understanding the difference between profit and cash. So you might have heard this one before. Turnover is vanity, profit is sanity, cash flow is reality. So it is very common for business owners to get frustrated that their bank account doesn't seem to reflect their profits. It's essential that you understand the difference between profit and cash and why a high profit doesn't necessarily result in more cash in your bank account. A profitable business can still go out of business because it's starved of cash. It's not uncommon for companies to grow too fast and then fall over. A business running at a loss could survive if it's got access to funds from shareholders, investors, banks. In other words, cash flow is every business's reality. So we're just going to have a bit of a look at some of the differences between profit and cash just to help you understand these. So consider these items. So GST, what column is that going to go into? So it affects your cash balance, but not your profit. It's never going to show up in your profit and loss. Loan repayments, again, affects your cash, doesn't show up in your profit and loss. Interest on loans, we have to pay them to the bank, so it's affecting our cash, but we can claim it for tax, so it's coming through in both places. Asset purchases, only affecting your cash. So when someone makes money, but they've spent it all on new cars, doesn't mean they've then still got money to pay the tax. You have to watch that impact on cash. Asset sales, same again, it helps your cash. Depreciation affects your profit. So that's a non-cash one, because it's just reducing the value over time. So there's one other one that's pretty critical, and when I talk with clients about where there's no cash, sometimes it's number 7, which isn't going to come up, but it's because of drawings. There's been money leaving the business, which hasn't been budgeted for, which has been helping the shareholders' personal balance sheet and helping their own lifestyle, but it hasn't been planned for, and then it can put us, can leave us in a bit of a pickle. As you can see, even if your business achieved a healthy profit, there might not be any cash in the bank after paying taxes and making loan repayments and buying new assets. So having forecasts of these things is really key. Don't want to have surprises. So the Business 101 cycle is another useful way to demonstrate the difference between profit and cash. So first, the owners have to invest money in the business. It's quite understandable. Then the money can be used to purchase assets needed to run the business. We might have to get extra funding to buy the assets, so you might get a loan to the bank at that point. And then those assets are used to generate a profit, hopefully. Now you can increase your profit by growing your sales, growing your margins, but you could have overheads and expenses that eat your profit up and result in a loss if they're not managed. The profit then gets turned into cash. There's lots of drains on cash, slow collection of debtors, high stock days, inventory days, loan repayments, tax repayments, payments to suppliers. So a business can achieve cash gains maybe by collecting their debtors faster, decreasing their stock days, negotiating longer payment terms with suppliers, and reducing tax. And then the owners want to take cash out of the business as drawings or maybe pay off personal loans. The remaining cash can then be reinvested into the business to purchase more assets and generate more income. And the cycle continues. So the goal is to go through the cycle as quickly as possible to increase the return on investment, making the cash work for you. And that's a very quick spin through that. Key drivers of business value. So after cash flow, the business value is the next most important measure of success. how to make your business worth more. A lot of people want to sell it at the end. We want to get paid for it. So part of knowing your numbers is understanding and measures the key drivers of what that business value is. So they're sometimes called key performance indicators, KPIs. So they might be your monthly recurring revenue, revenue growth month on month, revenue per client, number of new clients, or maybe your gross profit percentage. So every business should really have identified 3 or 4 potentially key performance indicators that can be measured, so that if you change one of those and if you make a small improvement, it'll have a big improvement on your business. They're different for every business. A business that has recurring business and customers that keep coming back, it's very different to one that just makes one-off sales. But that's something that we can help you understand and get reporting on. If we can't report on it, if we can't measure it, we can't make improvements. So what my best clients do, and what I'd suggest every business really should in some shape, and it doesn't have to be a major, is some form of monthly reporting. And it might be totally internal, or it might be something that someone else helps you with, whether it's a bookkeeper, an accountant, or someone internally. So each month I would recommend for everyone to prepare a management report pack that includes a profit and loss, a balance sheet, an aged debtors and creditors report, a KPI summary page, so potentially with even some graphs or something like that, and a short-term cash flow forecast. So a little bit of time each month with a recurring reminder in your diary to generate and review these reports is invaluable. If any of us is still a foreign language, talk to your accountant, and they can help you figure out how to build a pack that just mostly will generate with a few buttons, potentially in Xero, or that's something they could look to send out to you. Profit and loss at a minimum should include the current month compared to budget, current year to date versus budget. We can break things down a whole bunch more, but those are really the basics. We need to know, how did we think we were going to go and how did we do? And then what does that mean? That is the key part. It's all very well telling me that I'm 10 grand up on budget. Why? Was that something good I did? Or have I stolen some of next month's sales and so I should expect things to drop off? The balance sheet should compare the figures at the end of the most recent month to last month, and then potentially the third column of the end of the last financial year. That helps us to look at trends, to work out things like those debtor days. Aged debtors reports, a lot of businesses will know who's paying them and who's not, but there really should be a regular system to review those at least monthly for problem clients. A lot of people give credit to people who don't really deserve it. A KPI summary page should really be a summary of all the key metrics that tell you how your business is performing. Maybe something like sales per customer, average transaction value, number of new clients, those really key drivers of business performance. And then the other piece, which really does, I'd love more of my clients to understand this, is the cash flow report. So this is not a cash flow report to the bank that goes out 12 months and it's just finger in the air stuff, but it's what's my next 6, what's my next 10 weeks looking like? If all these things come in, if the debtors pay me on time, if they don't, if my bills come up, if I pay them on time or if I can't. Just having money in a bank isn't a good enough guide. So there might be 50 grand in the bank, but then GST due in a couple of weeks is 30K. And then I've got a 40 grand loan repayment. I'm short, even though it feels like today I have money. So a lot of businesses, they do just operate on that seat of the pants gut feeling, but it's not a way of good practice, and it's not how the best businesses will do it. You really want to be able to identify weaknesses ahead of time, because about the worst call you can make to your banker is, I can't pay wages tomorrow. What can you do? I need help. We want to be getting on 3 weeks ahead of time saying, I need some support. Then you've got a lot more options. There's a heap of software options to help with this. It doesn't have to be a manual process. It doesn't have to take a lot of time. So not having time, being too busy, unfortunately, is not an excuse anymore. And if you started doing this, you're going to make your bank manager so much more happy, and likely to even, it could affect credit ratings in a positive way. So enhancing business value. So there's some pretty key ways that a lot of business people will do to enhance their business value. First, you've got to have a plan. So copying last year, unfortunately, is not a plan for a lot of people that is going to drive it with any clear good result at the end. documenting things like organizational structure and roles within the business. Now, if you're on your own, well, some of this isn't going to be relevant, but we can still have goals for yourself over a year. Making sure your reporting systems are using current systems. So a lot of people are in Xero, in YOB these days, using old non-cloud systems are really, there's not much of that now. Making sure they help to make your business more efficient. Reducing reliance on owners of the business helps enhance value, as it will be easier for new owners to take over when the business is sold. Really, the ideal of any real business that's beyond a contractor, say, should be for the owners to make themselves as if they could be redundant, because then a new owner can come in and it's so much easier. We've got good processes, then your staff know what they're doing. And finally, identifying and managing risks means you can manage them before they become an issue and you're not fighting as many fires. So protecting assets. So a little bit of a difference. So we've seen throughout the webinar, profitability, cash flow, value of the business all affect you personally. If your business isn't profitable and doesn't have much cash available, you won't be able to pay yourself to fund your lifestyle. And that's just the reality, unfortunately. There's a few other things you can do to help protect your assets, which I'll quickly go through. So a lot of people will have worked out and will be trading as companies to reduce their liability. That's sort of step one, table stakes. Considering who should be director of your company and which assets are held personally by directors. So if something really goes wrong, say something in the health and safety realm, directors can be personally liable. Well, you might want to be careful what assets those directors own in their own names. Ensuring you've got security over any money you lend to others. And that's something that a lot of people don't do. They don't spend the time to get security, to look at the PPSR, to understand what that means. And then they come a cropper when the company falls into liquidation. Understanding alternative ownership structures for high value assets. For example, if the business owns the commercial premises, consider moving ownership of the building out of that company and into a separate company, or maybe a trust. You don't want to have lots of assets sitting in a business. It's just risky. You can always put assets back in, but if something goes wrong, we can't get them out in all cases. Reviewing your terms of trade and credit policies to ensure you only provide credit to customers who are likely to pay you. It's amazing how relaxed we are, and as someone new comes in and we just give them this free credit, and so many clients do it. We don't ask for deposits, we don't often check references, and then surprise, surprise, some of them don't pay straight away. Don't always ask why they're coming to me. Did everyone else say no? Reviewing insurances, making sure you've got sufficient protection. This isn't a set and forget. Insurance needs change. Make sure you have a good broker and you understand what they're telling you. Do you have business interruption insurance, indemnity insurance, and enough to cover the impact on your business of a big adverse event, as much as is practical to insure? Ensuring you undertake financial planning is number 7, to manage your personal wealth outside of the business. A lot of people, it's just all about the business. And then if the business doesn't sell for what they think it should be worth or what they feel they need in retirement, it can be a bit of a rude awakening. So it's much more than the business. That's just a part of the financial picture. Planning for the future, making sure things like wills are up to date, powers of attorney, clear plan to transfer your assets to the next generation. And I won't talk about this in any great length because it's a topic on its own, but family trusts. If you don't know what they are, if you have one and you don't know how it's used or what the point of it is, talk to your lawyer, talk to your accountant. They still have a lot of value despite people signing the death warrant, and particularly in protecting assets, they do still hold up, provided they've worked used properly. So adopting best practice. For me, and I can hand on heart know that my best clients do practice these 3 things. They have a plan. It's a business plan or a business recovery plan or some kind of goals, and it's written down and it's not set in a drawer. They look at it and they make their decisions based on it. They have a forecast which connects to that plan, and they have ongoing reporting and accountability. So they have somebody who can give them a poke in the side to say, well, you said you were going to do this, and have you done it? Okay, great. You've done these 3 things. What about this last one? I didn't get to it. Okay, well, let's put it on the card and we'll do it next week. When I know personally, when I'm accountable for something, even might be just something that's due before a next meeting, it gets done. Whereas when I'm not, when my name's not beside any action items, occasionally things take longer. So that's just typical for a lot of businesses. It's really valuable checking in, having someone to hold you accountable. Now that might be a spouse, but at the same time it might not be, because they're not always the best person, because you don't always want to be talking business every minute of the day. So as you can see, knowing your numbers is just the beginning, as it allows you to improve them and ultimately achieve your goals for the business. So where to from here in these strange and challenging times? What I'd really like you to think about is, what are some 3 actions, projects that will add value to your business? Take a minute, a few seconds while I'm talking, just to jot a few ideas down. It could be there's something in there that you just think, look, I just didn't get that at all. So then your action is ask someone, ask your accountant, ask someone who knows, a friend in business, to explain it to you. So it doesn't need to be about, I don't get it, therefore I won't ask and I'll just leave it to the accountant. It doesn't need to be like that. It doesn't have to be French. What problems are you experiencing in your business? Identifying the problems and then using them as an opportunity to create a project to fix them, rather than, oh, well, it is what it is. Often there are things that can be done, and it's not about fixing them so they go away entirely, but a 1% change here, a 3% change here makes a massive difference if there's a clear plan. So we do a lot of work in this space. If you don't have a business plan, I suggest you get one. We can also help you with updating cash flows. Particularly, this is a great time of year to be thinking about what's the next 12 months going to look like. Often you're needing to do that for the bank. Having some robustness around this and someone who's going to check on your assumptions, it's going to make that a lot more valuable. We do a lot of regular coaching with clients, whether that's monthly, quarterly, catching up to talk about it, not just for a chin wag, but to set clear goals, set clear action items makes a real difference. We do a lot of management reporting each month, catching up, but it's not about just sending reports. The value comes in helping clients to understand it. And I really would like it if I can get to a point with all my clients where I can show them a report and say, you talk me through it. And that's really the goal. Tell me what this means. I think really then we've really reached a great position. And finally, we can we'll catch up with anyone for a complimentary meeting for people who are clients and aren't clients, to talk about the challenges in the business. That's not a tax focused meeting. That's what are the challenges and what are the ways your business could be doing things differently. We know it could be hard to spend money right now. Last thing we're doing is a hard sell. In the short term, we have different payment options available, so don't let cost be a barrier, but get in touch so you understand what options you have. We're very confident that any benefits you get from the services would be far greater than any cost. Hand on heart, I wouldn't do it if it cost more than any value. And just one big caveat, anything I've said is general in nature and doesn't replace specific advice. So we've got what is the difference between annual accounts and accounts that can be produced throughout the year? That's a good question. So the answer is annual accounts contain year-end things, which we're not going to be doing every month because it's just not cost effective to be in and out of your files like that. But year-end adjustments like depreciation, getting the tax right, working out how much to allocate to shareholders, splitting interest and principal on loans, because often they'll just come through as one amount on the bank statement, sorting out prepayment and a whole bunch of other accountantese type things. But typically those aren't things that massively affect particularly a trading statement. So often that's a key one where you should be, that's really the gold is in understanding that throughout the year, rather than getting too caught up on things right at the bottom line. What's the difference between markup and margin? So this is a common sort of misnomer and can be mistaken. So we've talked about gross profit, gross margin, so those are the same. Is that the same as the markup I put on prices? So as a typical accountant answer, yes and no. The markup in dollar terms is the same as the margin, and that both of the difference between the cost and the selling price. But in terms of percentages, the markup and margin aren't the same. So if you buy stock at 75 and you sell it for 100, your markup's 33% because you're doing 100 over 75, but the margin's only 25%, $25 profit over the sale price of 100. So one question through, are you able to recommend a good cash management application? So there are a couple that I've worked with at different points. They all do. Some of the good ones will link into your software. So for example, it will know that I have 100 grand coming due for receivables next week. And then you can say, yep, this one will pay, this one won't pay. This will pay next week. This one's already contacted me. So that you're not doing manual entry. So one of them is called Float. And that's one that a lot of people are using. What is a profitable, reasonable margin to charge? Yep, it's a good one. But unfortunately, in typical accounting fashion, I can't give you a perfect answer. So it really depends on your industry. It depends on your competition. It's usually more than you think, because people will often undercut themselves just through lack of confidence. But that's really, we're talking through, people will get into business, they will know something about the industry. But talking with people, either competitors, if you can, doing some research in there, talking with your accountant. But there's some businesses, for example, like a home builder, they might be doing well if they can make a 10% margin in some of them, whereas plenty of other businesses will be 33%. So there is just a huge thing, and like I said earlier, a 1% change there could be huge. So it's important to work on understanding that, and working on understanding, well, I might be at 25% now, but what's the reason for that? Is that because of what's the strategy behind that? Have I put myself in the industry as a high volume, low cost kind of player? Am I pushing for quality? How is this all working? Should I be trying to raise my margins so that people perceive me as more high value? Those are the kind of conversations that you have when you're thinking about the plan for the year, thinking about the longer term strategy, rather than just, this is what I've always done, so I'll keep doing it that way. So I think that's all the questions. Feel free to email me or email Larissa if you have anything else after that. Thank you very much for coming along. We really appreciate it. I know everyone's time is very valuable. If you were able to, it'd be great if you could complete the exit survey that I think will pop up once you click exit, because we'd love to find out what you want to know about and how you found it. I hope you've given you a few ideas, but certainly don't die wondering. Pick up the phone, because there might be some really simple fixes, simple things that you can work on to really make progress in your business. With that, I will leave you to enjoy the rest of your day. Thank you.